Most people think the conflict between Binance and the SEC is just another regulatory lawsuit, a disagreement about compliance, a legal battle that will eventually be settled in court. That belief is dangerously naive, because what is unfolding between Binance and the SEC is not a lawsuit. It is a power struggle. And like all real power struggles in financial history, it has very little to do with protecting investors and everything to do with control. When the SEC sued Binance, the headlines focused on surface-level accusations, unregistered securities, commingling of funds, lack of transparency. But beneath those headlines sits a much deeper question, one that retail traders almost never ask. Who gets to control the future financial infrastructure of the world? Because Binance is not just an exchange, it is a parallel financial system that grew faster than regulators could contain. And the SEC is not just a watchdog, it is the enforcement arm of a legacy system that is watching its authority erode in real time. This is not about crypto being too risky. This is about what happens when capital, liquidity, and market access move faster than regulation. If you are a retail trader, this war matters far more than you think, because every time two giants fight for power, liquidity becomes the weapon, and retail always pays the price. By the end of this video, you will understand why Binance became a target, why the SEC chose this moment to strike, and what this silent war means for traders who think they are just watching from the sidelines. Because in financial wars, there are no spectators, only participants who don't realize they are already on the battlefield. To understand this conflict, we need to rewind, not to the lawsuit, but to how Binance grew so fast that it became impossible to ignore. Binance didn't rise like a traditional financial institution. It didn't ask for permission. It didn't wait for regulatory clarity. It followed liquidity. In the early years of crypto, Binance did something that most regulators underestimated. It positioned itself wherever capital wanted to move, not where rules were clearly defined. It built infrastructure that allowed traders across the world to access markets faster, cheaper, and with fewer barriers than traditional exchanges ever allowed. And retail loved it. Lower fees, more products, futures, options, leverage, altcoins, everything in one place. But here's the key insight most people miss. Binance didn't just attract traders, it attracted liquidity. And in financial systems, liquidity is power. Once liquidity concentrates in one place, control follows. This is where the tension begins. From the perspective of regulators like the SEC, Binance represents something far more dangerous than a non-compliant exchange. It represents a financial entity that operates globally while remaining structurally outside the direct jurisdiction of any single authority. That is unprecedented. In traditional finance, control flows downward. Governments regulate institutions. Institutions control markets. Markets influence retail. Crypto reversed that order. Markets moved first. Liquidity followed. Institutions adapted. And regulators arrived last. The SEC's problem with Binance is not just legal, it is existential. Because once a system proves it can move trillions in volume without centralized oversight, it exposes a painful truth. Regulation is reactive, not proactive. And when regulation becomes reactive, it loses leverage. This is why enforcement actions don't arrive early. They arrive when a system becomes too large to ignore. Not because it suddenly became dangerous, but because it became powerful. For retail traders, this context matters, because when power shifts at the top, volatility, uncertainty, and forced narratives are used to regain control, and those narratives almost always come wrapped in the language of investor protection. But history shows us something uncomfortable. Investor protection often comes after the damage is already done, and the damage is rarely accidental. The biggest mistake retail traders make when watching conflicts like Binance versus the SEC is assuming they are watching a legal drama from a safe distance. They are not. They are standing inside the blast radius. Most retail narratives simplify this conflict into two camps. Binance is either a reckless outlaw or the SEC is an overreaching bully. Both views are incomplete and dangerously misleading. Because the real pain is not caused by who is right or wrong. It is caused by how power reasserts itself when it feels threatened. When regulators feel they are losing control, they do not move slowly. They move decisively, publicly, and with maximum psychological impact. Lawsuits are not just legal tools, they are signaling mechanisms. The SEC does not need to immediately win against Binance to achieve its objective. It only needs to create uncertainty, because uncertainty freezes capital, and frozen capital is easier to control. Retail traders underestimate this dynamic because they focus on outcomes instead of incentives. From the SEC's perspective, Binance presents three unacceptable risks. First, Binance enables capital mobility at a global scale. Money can move across borders, jurisdictions, and regulatory frameworks faster than enforcement can track. That alone undermines the authority of any centralized regulator. Second, Binance offers products, especially derivatives, that expose retail traders to leverage without the friction traditional markets impose. This weakens the SEC's role as gatekeeper. Third, Binance normalizes a financial environment where access is permissionless. That is a direct threat to a system built on licensing, accreditation, and exclusion. Now look at the pain point for retail traders. Every time enforcement escalates, liquidity responds first. Market makers widen spreads, funding rates distort, order books thin out. Retail doesn't feel this immediately as regulation. They feel it as slippage, as stop hunts, as unexplained volatility, and they blame themselves. They think they misread the chart. They think their strategy stopped working. They think they just had bad timing. In reality, they are trading inside a battlefield where liquidity is being weaponized. This is the silent cost of regulatory conflict. Not bans, not headlines, but structural instability that punishes the least informed participants first. The real pain is realizing that retail traders are never warned when the rules of the game change. They are simply expected to adapt or be wiped out. The turning point comes when you stop asking who will win, Binance or the SEC, and start asking a more useful question. What does this conflict reveal about how markets actually function? The answer is uncomfortable. Markets are not governed by fairness, they are governed by leverage. And leverage does not only exist in positions, it exists in jurisdiction, narrative control, and liquidity access. The SEC's power does not come from superior market insight, it comes from its ability to define legitimacy. Binance's power does not come from ignoring rules, it comes from aggregating liquidity faster than rules can be enforced. Once you understand this, the lawsuit stops looking like a moral event and starts looking like a strategic one. Timing matters. The SEC did not act when Binance was small. It acted when Binance became systemic. That is the pattern repeated throughout financial history. Institutions are tolerated while they are experimental. They are attacked when they become influential. This reveals a crucial insight for retail traders. Regulatory action is rarely about prevention, it is about containment, and containment reshapes markets long before verdicts are reached. The moment enforcement begins, behavior changes, exchanges de-risk, liquidity providers retreat, capital becomes cautious. The revelation is not that Binance may have broken rules. The revelation is that rules are enforced most aggressively when they regain strategic advantage. For retail traders, this reframes everything. You are not trading a neutral market. You are trading inside evolving power dynamics. And once you accept that, your objective changes. You stop trying to predict outcomes. You start learning to recognize pressure. Pressure shows up before price moves, before collapses, before bans. It shows up in liquidity behavior. That is where survival begins.
To truly understand the silent war between Binance and the SEC, you need to shift your frame of reference. Stop thinking in terms of law. Start thinking in terms of market structure. At the core of this conflict is a single, uncomfortable reality. Modern financial markets are not controlled by rules first. They are controlled by liquidity flows, and rules follow liquidity, not the other way around. This is where smart money thinks differently from retail traders. Retail traders see regulation as a binary outcome, approved or banned, legal or illegal, safe or unsafe. Smart money sees regulation as a pressure variable, something that changes behavior long before it changes legality. The SEC understands this perfectly. A public enforcement action against Binance does not need to shut down the exchange to be effective. It only needs to alter incentives for the participants who make markets work. Market makers are the first to react. They don't wait for verdicts. They respond to risk asymmetry. When regulatory pressure increases, market makers widen spreads to compensate for uncertainty. They reduce inventory exposure. They pull liquidity from products that could attract scrutiny, especially high-leverage derivatives. This creates a cascading effect. Order books thin, volatility spikes, retail execution worsens. From the outside, it looks like market instability. From the inside, it is liquidity repositioning. Now consider Binance's unique position. Binance operates across multiple jurisdictions, offering a product suite that merges spot, futures, options, staking, and yield products under one roof. This vertical integration concentrates liquidity in a way traditional exchanges cannot replicate. That concentration is powerful, but fragile. When pressure is applied at the regulatory layer, the system does not break evenly. It fractures along points of exposure: fiat on-ramps, derivatives access, stablecoin rails, and banking relationships. This is why enforcement actions target interfaces, not core technology. The SEC does not need to dismantle blockchain infrastructure. It only needs to disrupt access points. This is exactly what happened in previous financial conflicts. Consider the case of BitMEX in 2020. Before enforcement, BitMEX dominated crypto derivatives volume. Retail traders believed the platform was too big to fail. But when U.S. authorities brought charges against its founders, the platform didn't collapse overnight. Instead, liquidity drained. Market makers exited first. Funding rates destabilized. Volume migrated elsewhere. Retail traders were the last to react, and they paid the highest execution costs during the transition. The same pattern applies here, but at a larger scale. Binance is not being attacked because it is illegal. It is being challenged because it is systemic. Systemic entities threaten control simply by existing outside established frameworks. From an insider perspective, this war is not about crypto versus regulators. It is about who gets to define market legitimacy. If legitimacy is defined by regulation, then enforcement is the weapon. If legitimacy is defined by liquidity, then scale is the weapon. Right now, those two forces are colliding. Smart money does not choose sides. It chooses positioning. Funds with exposure to Binance-linked liquidity reduce directional risk. They hedge regulatory tail events. They reprice volatility. They rotate capital to venues with lower jurisdictional friction. Retail traders, meanwhile, continue trading patterns as if no structural change has occurred. This is where most losses occur. Because the danger is not a sudden shutdown. The danger is gradual degradation, worse fills, more slippage, unexplained drawdowns. Smart money interprets regulatory conflict as a signal to slow down. Retail interprets it as noise. That difference in interpretation is where edge is created or destroyed. The deep insight here is this:
Regulatory pressure reshapes markets long before it resolves, and markets that are being reshaped punish impatience, leverage, and ignorance of liquidity dynamics. If you are trading during a period of regulatory escalation without adjusting risk assumptions, you are not trading the same market you were before. You are trading a battlefield in transition, and in transitional markets, survival is the first victory.
Once you understand that the conflict between Binance and the SEC is fundamentally a battle over liquidity control, your behavior as a retail trader must change, not emotionally, structurally. The first adjustment is risk perception. During regulatory escalation, risk is no longer symmetrical. Upside may remain visible, but downside becomes compressed and sudden. That means traditional assumptions, normal volatility, stable execution, predictable funding, are no longer valid. Retail traders make a critical mistake here. They keep trading size as if market conditions are unchanged. Smart money does the opposite. It reduces exposure not because it expects collapse, but because uncertainty increases the cost of being wrong. The second adjustment is venue dependency. When regulatory pressure rises, access points become fragile. Fiat rails, banking relationships, derivatives permissions, these are the first areas to fracture. Traders who rely on a single venue for custody, execution, and leverage concentrate risk without realizing it. The practical implication is simple. Never assume operational continuity. Always assume friction will increase before clarity returns. That means keeping capital mobile, reducing leverage, and treating exchanges as execution tools, not vaults. The third adjustment is liquidity awareness. Retail traders often obsess over entries and exits while ignoring the environment that determines whether those trades can even be executed efficiently. In periods of regulatory pressure, liquidity becomes selective. It favors size, relationships, and flexibility. Smaller traders feel this as slippage, stop runs, and failed breakouts. The correct response is not to trade harder, it is to trade less with more patience and wider margins for error. Finally, there is a mindset adjustment. Regulatory conflicts create narrative traps. Fear-driven headlines push traders into binary thinking, bullish or bearish, safe or unsafe. Smart money avoids this trap by focusing on probabilities, not predictions. The question is never, what will happen? The question is, what positioning makes sense if volatility increases and liquidity deteriorates? That shift from prediction to preparation is what separates survival from attrition. The silent war between Binance and the SEC teaches a lesson most retail traders learn too late. Markets do not change when verdicts are delivered. They change when power dynamics shift. Regulation is not a moral force, it is a strategic one. And exchanges are not neutral platforms, they are nodes in a global liquidity network. If you trade without understanding where pressure is building, you will always feel surprised by outcomes that were visible in advance. The goal is not to fear regulation, the goal is to respect its impact on liquidity, behavior, and risk. When you start thinking this way, trading stops being about catching moves and starts being about staying aligned with structure. That alignment is what keeps you in the game long enough to compound. If this analysis helped you see the market differently, subscribe to Starro Trading. This channel is not about hype, signals, or shortcuts. It's about understanding how markets actually work so you can survive them. Leave a comment with your perspective on the Binance-SEC conflict. Not who you think will win, but how you think liquidity will respond. Because in the end, markets don't reward opinions, they reward preparation.